All right, guys, so let me just put it up on the screen because I know a lot of people have been upset. They've been confused. If you're a prospective home buyer, you're looking to buy a home in the next several months, there's going to be some changes and it might cost you a little bit more if you have good credit. And you guys let me know whether or not this is fair or not. But let's go over what's going on right now. This is kind of trending at the moment. People with higher credit scores may end up paying more, while those with lower credit scores will pay less. That's counterintuitive. That's literally like the opposite of what we teach on the money codes. But let's break it down. What are these changes and why are people with the best credit scores having to pay more in order to buy a house? Let's break this down. All right, so now traditionally buyers with higher credit scores get rewarded with more affordable interest rates and closing costs, right? This is what we preach. The higher your credit scores, you're able to get the best interest rates. Lenders typically give you their best programs if you meet those thresholds of usually, good down payment, high FICO scores. You get rewarded for that. And those with lower credit scores need to pay more to compensate for the fact that lenders look at them as higher risk. Again, this is something that we've been accustomed to. Traditionally, these were the rules for the mortgage industry. After May 1st, it's not going to be quite the same. Upfront fees for loans backed by Fannie Mae and Freddie Mac will be adjusted because of the changes in the loan level price adjustment, otherwise known as the LLPA. Now, let's rewind for a second. Side note, guys, I did a 3.5 hour webinar breaking down the ins and outs of the home buying process. That's in the inner circle, right? It goes over concepts like this, but 10 times in more depth in the inner circle. So I got to plug that. Fannie Mae and Freddie Mac are the two largest players in the secondary mortgage market. So their whole job and their whole purpose is to be able to buy up other loans. That way it allows your local banks and your local mortgage brokers to be able to continue to offer you new loans. Why? Because they know that Fannie and Freddie are going to buy those loans on the back end. So if it wasn't for Fannie Mae and Freddie Mac being such an integral part of the mortgage industry, many of us wouldn't even have the loans that we have right now, right? They're super important. So what's up with this loan level priced adjustment? What is this LLPA? If you have higher credit scores, you're still going to be getting the best interest rates. However, it just means that they're going to be putting a little bit more on top of what you would have normally been paying. It's still going to be better than someone with bad credit or even average credit. But those with good credit and excellent credit, you're still going to have to pay a little bit more than what you've been accustomed to paying. And I'm going to give you an example, I believe, on the next slide. However, the penalty now for having a lower credit score will be smaller than it was before May 1st. So the best credit, you guys got to pay a little bit more. The mediocre-ish people, you're going to end up paying a little bit less. And here's a screenshot of the LLPA. This is basically just a matrix that Fannie and Freddie use and the lenders use. I think this is cropped out. So what I'm going to do is probably going to put like a larger version of this chart, of this matrix on the screen so that you can see. But really the only takeaway is if you look from top to bottom, you're going to notice that, again, the higher the credit score, the lower the rates and the lower the fees that someone typically has to pay. But this matrix right here is what the Biden administration has changed starting May 1st. So let's look at an example with someone who has average credit, right? So if you had a 659 credit score, and 659 it's not bad, it's not the best, it's it's okay. If you had a 659 credit score and are borrowing 75% of the home value, which means you're putting 25% down in this example, you'll pay a fee equal to 1.5% of the loan balance. Before these changes, you would have paid 2.75% fee on a $300,000 loan. That's a difference of $3,750. Remember, I told you, if you guys have, again, mediocre type of credit, the amount in fees that you typically would have paid is now going down. It's now decreasing. I can definitely see how this is actually going to impact first-time home buyers, younger borrowers who don't have a substantial amount in down payment. Back when I was an on-site agent, I would see a lot of people come in, they're able to qualify, but because they're young, because they're, single mothers, coming from a family that never really owned before, they're coming in on a shoestring budget. So I can definitely see how reducing these fees is actually going to make it easier for a lot of the first time home buyers to actually purchase their first home. So what about someone with good credit? If you had a credit score of 740 or higher, right now we're in the range where we really want to be, 740 and above, you would have paid a fee of 0.25% on a loan for 75% of your home value before May 1st. Okay, so before May 1st, you put 25% down, you have very good credit, you would be paying approximately 0.25%. After May 1st, you could pay as much as 0.375%. So on the surface, you might be thinking, okay, that's not a huge increase, but when you're looking at loan amounts in the several hundred thousands, a tenth of a percentage point, that's still a good chunk of money, especially if you're looking at homes with a loan value of 300,000, 400,000 and above. It's not necessarily fair for somebody who has perfect ideal credit, who's been taking care of, again, their credit profiles, to make sure their balances are in check, they know their utilization, they don't have a whole bunch of just mess on their credit profile. I'm not a fan of the fact that those are the people that are going to have to pay more. I do like lowering the fees for people that, let's say, are in the mid 600s, but increasing the fees with people with good credit, just not a fan of that. All right, so what is this going to apply to? So any loan that's guaranteed by Fannie Mae or Freddie Mac, we already discussed their involvement in the lending industry. So regardless of the lender, if it's a Fannie Mae or Freddie Mac guaranteed loan, these changes are going to apply to that loan. Fannie Mae and Freddie Mac loans make up 60% of all new mortgages, and this was the data coming out of the pandemic. And the Biden administration implemented this as a means to provide equitable and sustainable access to home ownership to the low to medium income first time home buyers. When I talked about Wells Fargo and I talked about the disparity among races and geographic areas, how it's a little bit harder for some demographics to be able to purchase their first home compared to other demographics, other zip codes, right? So we pointed that out. The disparity is there. I'm just not sure that this is the way that's going to equalize it or to make it a level playing field. Again, I'm not a fan of penalizing someone who's been taking care of their finances, their responsibilities, doing the proper things. I just can't see how we can justify that to help those with mediocre credit, right? The problem is there. I'm just not sure that this is the solution to meet that problem, if that makes sense. Maybe I'm tripping, maybe I'm bugging. So really the advice that I would give you is not really much different than what I would have told you prior to the change. I still believe you need to reach out to at least a minimum of 3 different lenders, loan officers, and people who, are involved in this on a day-to-day basis. They're going to have much more insight. They're going to have much more information for you to take advantage of. But regardless, you should be talking to at least 3 lenders and shopping them. What programs do they have? What programs do they have for your credit score? Get an idea of what your down payment is going to be. Let some of these lenders fight for your business, and then you can make an informed decision based off of the numbers. So these are the changes. This is the update. I'm definitely going to do an updated video as more information comes out. Those with an ideal credit score, 720, 740 and above. If it's a Fannie Mae or Freddie Mac conventional loan, expect you're going to have to pay a little bit more, guys. It is what it is. But those low to medium income first time home buyers, those couple of grand that you're going to be potentially saving, you can go ahead and work with your lender, and you can go and probably either buy down your rate if that's an option for you, or maybe you can put towards repairs of the homes or different other costs. It's going to help first time home buyers, but again, someone made the comment, those with good credit are going to be subsidizing those with poor or average credit. And guys, it kind of looks like that's the case. So let me know if I'm tripping. Give me your thoughts down below. Like, subscribe, hit the bell notification, and I'm gonna check you guys in the next video. Peace. Hey, what's up, guys? If you're still watching and you're enjoying the content, click the link below and get access to my cheat sheet guide. It's a free PDF, how to get an 800 credit score without any gimmicks or fluff. With this info, you can start cleaning up your credit profile today.